Hello and welcome to the Monday Futures Market Outlook for November 12th, 2012. This is Patrick Ceresna. For those of you that have not had the opportunity yet to try out the eminisource.com trading room, complimentary memberships are available on our website. We have now taken all of our intermarket analysis and put it together in writing in a newsletter called the Market Timing Strategist. We're excited about this as we now are able to put in writing many of the very things that we are talking about here during these regular videos. To learn more about it, please visit markettimingstrategist.com. As always, we start off with the US dollar index futures, and we've been relatively optimistic and bullish over the last month on the US dollar, looking for it to proceed higher. We were looking for this rally to last up into the 81 to 82 area, which is now a fulfilled upside target. While there certainly is room for the US dollar to strengthen further, we no longer view it as a good new buying opportunity, but rather you can continue to hold positions you have or be profit taking into this short-term strength. It's not something that we feel is imminent or urgent to do, but we no longer find it as attractive to buy until there is another buy on dip opportunity presented. Next here, I want to take a look at the euro, and the euro has finally got some momentum selling that came in over the last little bit. Our first downside target was right around the 127 level, but we see room for the euro to even potentially weaken 200 more pips down toward the 125 level on the downside. We overall do believe that the euro can still further weaken, but a lot of the selling has already occurred. So shorting the euro even further here would be purely for day traders or very short-term swing traders, and rather we'll have to wait for new bounces in order to re-engage any new shorts on the euro. Next here, I want to take a look at the 30-year Treasury bond, and the Treasury bonds have had a material rally in the last week, and it was quite substantial. It has now rallied to the highs from August, and we're not far off from the 153 to 154 area up above where there is material overhead resistance. At this juncture, there is a chance that the Treasury bonds may actually have a substantial breakout on the upside. It is possible, but at this point, the risk-reward proposition into this overhead resistance is very poor. At this stage, if you haven't gone into Treasury bonds yet, you might as well at this point wait to see whether or not they break to higher highs and then trade the momentum at multi or all-time highs on the Treasury bonds. It's not worth taking the risk right in here. In fact, anyone that's been long Treasury bonds off of the lows, similarly, it is worth hedging or taking profits up into these overhead resistance levels and then repositioning if it's proven that the Treasury bonds are making another meaningful move to the upside. Next here, I want to take a look at copper futures, and copper selling has been quite substantial. We've seen it break down below even some of our key downside supports. That doesn't mean copper isn't going to put a short-term low somewhere and reverse back up, but there is definitely risk and for this to trade all the way down to 3.25 to 335, where all those previous lows have been. At this stage, this is going to be a key levels that we're going to get important decisions. We are reluctant to change our risk-reward stance on commodities to bullish just yet, but we want to see how the price action behaves here. I marked off the $3.62 level, give or take, because any short-term rallies in copper that fail below there could still lead to new selling. But if we have any substantial reversals in copper that has meaningful progress back onto the upside, we will change our risk-reward proposition to a more bullish outlook at that juncture. Next year, I want to take a look at crude oil, and crude oil is in a very similar situation to copper. It has not traded all the way back down to its lows from June, but the selling has already been quite extended and very solid on the downside. There is always the risk here that crude oil weakens all the way down towards that 79 focal point, give or take a few points. But also, we are seeing a lot of price action stalling right here at this very 84, 85 level. Every time we see see selling down there. It's brought in buyers. If we, for whatever reason, had a meaningful rally back above $90, and you can almost just draw a trend line connecting all of the highs of the pullback, then we would start to contemplate the idea that a bottom could be in crude oil. But again, we're reluctant to be rushing to get excited about the buying opportunity until the price action further supports it. The situation in gold is a little bit different. We were looking for a direct pullback into the 1650 to 1700 for the buying opportunity, and we got it very quickly. It stayed traded one day down there and stayed there for an additional day, and then subsequently had a material reversal off there. There is always the chance that there will still be one more round of selling that retest those zones on the downside, but we feel that down at these levels, buying gold represents a very good proposition, and gold has done something that copper and oil have yet to do, which is make a meaningful reversal off of a key level. You can see that rally from 1675 to 1736 has put in a solid 50 to 60 point rally in gold, and it's not being given back, and that is price action that is very constructive, which actually makes us optimistic gold here. Finally, I want to take a look at the S&P 500 and the broader stock markets, and we finally have got a correction right into our buy zones. The 1340 to 1380 level was where the correction we were looking for it to go on a proper retracement. This is now a 7% market correction to its lowest point, while there's always room for the S&P 500 still to weaken yet again this week. We finally are at the price levels where we are very interested in accumulating. We are unlike some fear mongers out there. We at this juncture view this as far more of an opportunity than we do of something more ominous. So right here, look for the buying opportunity. Watch to see if the bottoms come in. If they do, then this may be the short-term swing low that leads to a Christmas rally. Just to make our key intermarket observations from a risk-reward perspective, we've changed our U.S. dollar stance to just average from being good, as the U.S. dollar has reached our upside targets. We're not necessarily concerned about the U.S. dollar here, but we are certainly no longer finding it attractive from a risk-reward perspective. Now, we did not change our stance on commodities. If it was just gold that was doing it, would have already been good. But copper and oil still have vulnerability to still banging out some lows. Maybe we'll reserve it for another week or two from now to change the stance, but at some point we will be buyers of commodities. Now, bonds are trending higher. There's a very distinct uptrend there, one that could actually still follow through, but we viewed the risk-reward proposition of owning those bonds going into overhead resistance to be poor, and so we want to take positions that reflect that. Now we're making a bold call here, and without seeing those lows being banged out on the stock market yet, we are changing our risk-reward proposition to good, based purely at the level that the stock market's at. For those of you that are technically inclined, you could look for technical evidence to support that through indicators or trend line breaks or other things like that that may be your call to action. But we feel at this point, with us having been on the sideline from the stock market looking for this correction, we have now corrected enough to feel that this is meaningful. Now, we have not changed that stance on global stocks, particularly because a lot of markets have not had meaningful pullbacks. The Australian market, Canadian market, German market, you can go the London market, have not had the same type of deep pullbacks that we've seen in the U.S., which it's not that it's not a buyable market, but it's at this point not good enough for us to rate it as a good risk-reward proposition. If we were looking at the Asian Pacific markets, particularly particularly China, Shanghai, and things like that, we actually do view them as good opportunities. So we're kind of trying to basket label the rest of the global markets here, but we overall felt that rating it good is not appropriate at this juncture. But we are viewing opportunities here, and we think that our members and our followers of our videos should be looking for opportunities here to put their money to work. That was your Monday Futures Market Outlook. Thank you for joining me.